Passive Pockets is presented by Equity Trust. Roth conversions can be one of the most powerful tax strategies for passive investors using retirement accounts, but they're also one of the most misunderstood. What exactly is a Roth conversion, and how does it work in a self-directed IRA or a solo 401k? Should you convert before or after your asset appreciates? Can you transfer real estate or syndications in kind, or do you need to liquidate first? We'll cover all of this and more. This is Passive Pockets, presented by Equity Trust, and today we are diving deep into Roth conversion strategy with John Bowens, certified IRA services professional from Equity Trust. I'm your host, Jim Pfeifer. Let's get into it. John, thanks for coming on the show again. We're happy to see you.
Yeah, likewise, Jim. Thanks for having me again.
So today we want to touch on a couple topics, and the first one is Roth conversion. So can you start with just talking about what is a Roth conversion and how does it work in a self-directed IRA or a solo 401k?
Yeah, so the basics of a Roth conversion is when a taxpayer has pre-tax retirement accounts. Think a traditional IRA, maybe a 401k from a previous employer, and all the money that they were contributing, they were getting tax deductions for that. And so that's a tax deferred account, meaning eventually when they distribute money from that retirement account, they'll pay taxes. So for example, let's say with a traditional IRA or pre-tax 401k, I was getting deductions going in, I grow the account to, let's say, $1 million. And then at 59 and a half or older, I decide I want to take $100,000 from that traditional account, that pre-tax account. So when $100,000 is distributed from that pre-tax account, that's when I have to pay taxes. The analogy we use is you either pay taxes on the seed or you pay taxes on the crop. So using that $100,000 example, I distribute $100,000 from my traditional IRA. That's added to my ordinary income, and then I have to pay taxes accordingly. So let's say my effective tax rate is 20%. So 20% of $100,000 using my example is $20,000 in taxes. Remember, I was getting tax deductions going in. I get tax deferred growth. That, of course, can be valuable from a compounding interest perspective, but I do have to pay taxes when I take the money out. There is an option for a taxpayer to say, hey, rather than paying taxes down the road, I can pay taxes now. This is what we call a Roth conversion. So using the example that we had, let's say I forecast to be able to grow my traditional IRA to $1 million. And let's say right now it's only at $200,000. And I can convert my traditional account today from the traditional account to a Roth IRA. Now, within a solo 401k plan, you have traditional and Roth money. So there's a possibility of actually doing this within a solo 401k plan as well, which we can talk about in a little bit more depth. But just specific to IRAs, staying on that topic, if I have a traditional IRA, let's say 200,000, I can say, hey, I'm going to go ahead and convert that 200,000 over into the Roth IRA. Now, because that's pre-tax going into after-tax Roth, I do have to pay taxes. Now, there's no penalty. There's no 10% premature withdrawal penalty as long as I do this the right way, but I do have to pay taxes because, again, I'm going from tax deferred into tax-free Roth. So using the example of 200,000, I convert 200,000 from my traditional IRA to my Roth IRA. $200,000 is added to my ordinary income, and then I pay taxes based on my effective tax rate. So let's say I'm at a 20% effective tax rate. 20% of 200,000 is $40,000. So I pay $40,000 in taxes to get the 200,000 into the Roth IRA. Now, as we go further into this, Jim, we can talk about things such as converting in stages, partial conversions. You don't have to convert the entire balance of your account. Maybe you convert just some money now, some money in year 2, year 3, year 4, year 5, 6, so on and so forth. It really is going to depend on the taxpayer's individual account balance, their tax rate, what they think their return on investment is going to be. So actually forecasting their longer term return on investment. And of course, visit with their tax advisor to determine what's going to make the most sense for them.
Yeah, and that's a great description. But the great point at the end is, we're not tax advisors. We are not your financial advisors. So talk to all the professionals in your life. But, this is a great way to, if you convert, then you get tax-free growth for the rest of the time that you have that account. And so when does it make sense then to convert traditional funds to a Roth? And especially when we're talking about, private investments like the syndications that our community invests in.
So a good way to look at this for any investor is just like you said, Jim, we're not tax advisors. Meet with your tax advisors, and even prior to, start putting some pen to paper, create a spreadsheet and model this out to look at long term what this will look like for you. The equation that I like to look at this through is, number one, what is your return on investment? What's your forecasted return on investment on an annual basis? Now, for people that are only investing in stocks, mutual funds, traditional investments, you may want to look at applying whatever your historical return is, or of course, forecasting what you think your future return is going to be. Now, of course, just like they say, past performance is not indicative of future results, right? So you have to understand that when you're investing in the public markets like stocks, mutual funds, ETFs. Now, in our world, and my background is all in real estate and alternative investments with self-directed IRAs and solo 401k plans. So for those of you out there that feel you have more control of being able to invest in real estate with your retirement funds instead of the traditional stock market, a self-directed IRA or solo 401k will enable you to do that. So look at, what do you think your return on investment will be investing in real estate? That's variable number one in the equation. Variable number two in the equation is number of years. Or you could say just time period. So how many years do you intend on growing this account? Is it 5 years, 10 years, 15 years, 20 years? Now, the mathematics are pretty linear, meaning the longer the time period before you want to start taking money out of the account, the bigger the impact's going to be. That's providing that your return on investment variable stays constant, right? Or potentially increases, and then your returns are even better. So again, just look at this as a linear equation. The third variable of the equation is not necessarily a linear component, but I would say this can be a little bit more abstract. And that's, what do you plan on doing with your retirement funds? Do you need your retirement accounts in your retirement, or do you plan on leaving those to your children or potentially your grandchildren? And this is where we get into legacy and estate planning. So that's what I call the Roth formula, Jim. I'll put this into context for everybody with a real world example. Two clients of mine, Kevin and Cynthia, when they were in their early 50s, they had 401k money from their old jobs. They had about $117,000 to start with, all pre-tax in their 401ks, because most of Americans are contributing only on a pre-tax basis to their 401ks because they're not thinking about the compounding interest in the absence of taxation with a Roth. So they had about $117,000 combined between the two of them. It was just over $100,000 in the one spouse's account, and then just over $50,000 in the one spouse's account, and then about $50,000 in the other. So a total of about $117,000. And so what they did in 2011 and 2012, over 2 years, they converted their money. So that's what we call converted in stages. So spouse A converted some money in year one, spouse B converted their money in year two. So they spread out their tax burden over 2 years. Now they've done well over 40 real estate transactions. And because they're finding opportunities that have significant appreciation and significant cash flow, they're in a position where all of their tax-free dollars are going into their Roth IRAs and they're paying 0% tax. And so they converted about $117,000 over 2 years, over 2011 and 2012. They spread out their tax burden over 2 years, got the taxes out of the way. They've since grown their Roth IRAs to over $2 million in property value, and they're generating approximately $200,000 in net tax-free cash flow on an annual basis. And so when you look at those numbers, and of course, it's not always easy to forecast, but when you look at numbers like that, it's proof that for Kevin and Cynthia, it made a lot more sense to pay the taxes on the smaller seed than the much larger crop.
So, John, I've heard about this, converting assets in kind where you don't need to liquidate first, because, if you're talking about just a traditional IRA investor, like you said, they're in the market, they can just convert to cash and then, convert the traditional to a Roth and then go back and put, new investments, right? But if you're investing in syndications, they're very illiquid. So it's not quite that easy. How do you then, let's say you have $500,000 in your traditional self-directed IRA and it's in 5 different syndication investments of 100 grand each, do you have to sell those, or can you somehow transfer those, and how do you pay the tax?
Yeah, so converting an asset in kind is certainly possible. For example, let's say in my traditional IRA, I own a single family rental property. And let's say I go to a broker and get a broker price opinion, or I actually get an appraisal, either one, and the value comes in at $200,000. And then I convert that entire property from the traditional account to the Roth IRA. So I pay taxes based on the value. If it's $200,000 gets added to my ordinary income, and then I pay taxes accordingly. So just using the same example that I mentioned before, $200,000 property gets converted over to the Roth. I, of course, am going to have to come up with the cash out of pocket. So I'm not going to withhold from the account to pay the taxes. If I withhold from the account to pay the taxes and I'm under the age of 59 and a half, that amount's treated as a distribution that I withhold and is going to be subject to a 10% premature withdrawal penalty and ordinary income taxes. So many individuals do not pay the taxes by withholding from the account, but rather they pay out of pocket. So using that example of a $200,000 property, $200,000 is added to my ordinary income, and then I pay taxes accordingly when I file my tax return. I would encourage folks to meet with their tax advisor as they're planning to do this and as they execute throughout the process, because there could be a scenario where they have to pay estimated taxes. So they'll have to file the necessary forms and pay the necessary estimated taxes when they do this. Now, to get to what I think you were asking, Jim, I use the example of a single family rental property. But what if I invest in a real estate syndication? Call it an apartment building. Let's just use that example, right? We see a lot of those. It's a multifamily property. I'm a limited partner in a real estate syndication. I'm not the general partner. I'm a limited partner now. And let's say that I use my traditional IRA and I invest $100,000 into a real estate syndication. And this doesn't work in all cases, all right? Let me make sure I preface it with that. But it can work in some cases. I can go to a CPA and I can have them perform a valuation. Now, that valuation may come in at significantly less than $100,000. Maybe it comes in at $55,000, maybe $60,000, maybe $65,000. And so now, instead of converting at $100,000, I convert at $60,000 or $65,000. In other words, I'm paying taxes on $60,000 or $65,000 instead of $100,000. Instead of $100,000 being added to my 1040 as ordinary income, only $60,000 or $65,000 in my example is being added to my ordinary income. This is what folks refer to in the industry as the discount conversion strategy. It requires very special planning, and most importantly, it requires planning by a tax advisor that understands how this works and can perform the necessary valuations. Now, why does this work, or why can it potentially work? Well, when you're investing in a real estate syndication, there can be arguments from a tax perspective that you have a lack of liquidity or lack of marketability, meaning you make the $100,000 investment in my example, and you can't just the next day, like a stock, mutual fund, or cryptocurrency, you can't just the next day put in a request and sell that asset, right? It's an illiquid investment. And so because of that, in some cases, a CPA can argue that the value is not what you put into that opportunity. The value is actually less. Anywhere between 15 to 30% is typically what we see. Then there's a second component to this, which is referred to as lack of control. So when you read the private placement memorandum and other offering documents for these real estate syndications, usually you're going to see in black and white that you don't have voting rights. So because of the lack of control, you can get an additional discount. Depending on the circumstances, it could be anywhere between a 30 to 60% discount. In my experience in reviewing these, I generally see anywhere between 30 to 45% discount. I'll give you a quick example, Jim, and I think this will help some of the audience members really put this into perspective. I had a client at the end of last year. They did this with their solo 401k plan. So just like a traditional IRA, you can do the same in a solo 401k plan. In a solo 401k plan, you have a traditional, call it pre-tax bucket, and then you have a Roth bucket. So what she did is she rolled over a traditional IRA into a newly formed solo 401k plan because she's a self-employed person. So that's in her traditional bucket, hasn't been taxed yet. She invested that $100,000 into a multi-family real estate syndication. It was, I believe, in Tennessee. And that $100,000 investment sat within the pre-tax bucket of her solo 401k plan. She then went to her CPA. The CPA created somewhere around 30 to 35 page report that ultimately describes why the value is not 100,000, but it's actually 55,000. Under those two conditions that I mentioned, lack of marketability and lack of control. So now within her solo 401k plan, she updated the asset value from what? 100,000 to 55,000. She got a 45% discount. Now, the intrinsic value didn't go away, if you will, right? The material value, the asset is still there. The asset's performing. The syndication opportunity is doing well. She got her first preferred payment on time, and that preferred payment went into her Roth account because she converted the asset at 55,000 to the Roth side of the solo 401k plan. And Jim, when I did some just back of the cocktail napkin math here, she ended up saving about $12,000 to $13,000 in taxes, converting that asset over from the traditional bucket to the Roth. So now she has that asset in her Roth account. All of the preferred distributions are flowing into her Roth tax-free. All of the growth or appreciation is tax-free in the Roth. And eventually, when that deal sells anywhere between 3 to 5 years, all of the capital gains will go where? Into the Roth. Will she pay any tax? 0% tax. And like we've talked about, Jim, in other podcasts before, the reason why a solo 401k plan in an opportunity like that is found in section 514C9A of the tax code that has an exemption from unrelated business income tax. So this individual client is actually taking advantage of multiple exceptions or multiple tax strategies within the solo 401k plan to be able to save herself on some taxes on the conversion and have all tax-free upside in her Roth going forward.
That's fascinating that you can do that. So a couple of questions here, just follow-ups. Let's say someone has $500,000 in an IRA and it's self-directed, right? And you're investing in, maybe it's just in cash for now. Wouldn't it make sense then to invest it in syndications that you were already going to invest in anyway, right? Let's say that's what you do. You like to invest syndications. Why wouldn't I just invest the $500,000 of cash I have in my traditional self-directed IRA, invest in the syndications, get a CPA to revalue them, and now I'm going to save all this and then convert it to Roth, and then I basically just decreased the basis, so I'm going to pay a lot less tax, and I was going to invest in those deals anyway. Does that make sense what I'm trying to ask?
Yeah, absolutely. So I've heard comments like that before, and the comments are not wrong, but they're also not right. It's a point of debate.
Okay.
Because it all goes back to that Roth equation that I mentioned, right? The Roth equation is what? Return on investment. Now let's assume that there's syndications that the investor feels confident in. Maybe the operator has a really good track record and they feel good about the expected internal rate of return or the overall expected return on investment. So let's assume we have a constant of return on investment. Variable number 2 is what? Time. So the 50-year-old is going to look at this a lot differently than the 30-year-old. The 30-year-old has how many years before 59 and a half? They have 30 years.
Yeah.
So that variable in the compounding interest Roth conversion equation becomes that much more meaningful, right? And so that's something for folks to think about. It's not for everybody, but if there's enough time behind you, the return on the investment is substantial enough, the argument of converting from traditional to Roth is in some cases a no-brainer for an individual investor. And that's where it's sharpen the pencil and start doing the math. Just from a theory perspective, Jim, here's the way I look at converting or not converting. A traditional IRA, by the way, when I say traditional IRA, think pre-tax 401k, pre-tax solo 401k, pre-tax 403b, simple IRA, SEP IRA, even your thrift savings plans, right? Most people, all their money is pre-tax. They got deductions going in. Guess what? you are in partnership with the IRS for the rest of your life.
Yes.
You do everything, right? You put up all the money, you do all the work, you put in all the time, and then at 59 and a half or older, when you start harvesting, what happens? The IRS is there to take their cut. And that cut is going to be dependent on your tax rate at that time, which there are many factors involved in those particular situations. And it's not just your own individual tax situation, it's also tax policy. As tax policy changes, right, what's going to happen to your situation there? That's going to change as well. Might be for the better or for the worse. I don't know. I'm not here to predict politically what's going to happen. So that's something to think about. With the Roth account, what are we effectively doing? We're paying taxes on the smaller seed. Let's assume that that smaller seed grows to a much larger crop. So now we're not paying taxes when we take the money out after 59 and a half. Some other things to think about around Roth accounts, Jim, really important around Roth accounts. The amount that you distribute at 59 and a half or older is not subject to taxes, as long as you've also met something called the 5-year seasoning rule. But let's assume that you qualify, you can distribute from your Roth and pay 0% tax. And that amount that you distribute is not added to your ordinary income. If you're not adding money to your ordinary income, you're not affecting other things from a tax perspective for yourself. Kevin and Cynthia are great examples of this. So Kevin and Cynthia, they're generating over $200,000 in net tax-free cash flow from their properties that they own in their Roth IRAs. They own them free and clear. It's all tax-free in their Roths. There's no recapture depreciation. There's no ordinary income taxes. There's no capital gains tax. It's all tax-free in their Roths. Every year, because they're over 59 and a half, they can distribute money from that Roth IRA and pay 0% tax. So they could distribute $200,000 if they want of their cash flow every single year and pay 0% tax. Technically speaking, they could distribute the properties and pay no tax either, but why would they want to do that? Why wouldn't they keep them in their Roth and continue to grow it 100% tax-free? The other thing that I think is really important, Jim, to mention here is that Roth IRAs have interesting distribution characteristics. I like to call this the Roth IRA layered cake. Now, that's not a technical term. You're not going to find that in Publication 590. You're not going to find that in Internal Revenue Code Section 408. So don't look for Roth IRA layered cake. Look for ordering rules. What I'm actually speaking about in terms of the technical aspects of it, ordering rules. Here's how it works with a Roth IRA. When I distribute from a Roth IRA, I distribute in a layered cake fashion. I start with contributions, then I move into amounts that I've converted from traditional to Roth, then I move into earnings. Here's how contributions work. Any amounts that I contributed to my Roth IRA or Roth 401k, I can take out at any time tax and penalty free, even when I'm under the age of 59 and a half. So for everyone out there that's on the, I think it's called FIRE, Financial Independence Retire Early. I know that's a big part of PassivePockets and BiggerPockets holistically. There's a way to do that. There's a way to not have to wait till you're 59 and a half. And that's exactly what I'm telling you with this Roth IRA or Roth 401k. You can take out what you contributed anytime tax and penalty free, and it's first in, first out. So you eat the cake, how? It's a layered cake. You eat it from the top down instead of having to take a slice out of it and take money out of each bucket. So then we move on to the second layer, which is conversions. Any amount that I convert from traditional to Roth, as long as it's seasoned for 5 years, I can take that amount out tax and penalty free, even under the age of 59 and a half. Then I move into earnings. Earnings will have to stay in there until I'm 59 and a half. So I do have to allow those earnings to stay in there until I'm 59 and a half. But Jim, what I'm telling you here is, let's say you have 200,000 in a traditional, and maybe you do one of these discount conversions like you were referencing before. You convert it over to Roth. That amount that you convert over to Roth, once that's seasoned for 5 years, you can distribute that money even prior to 59 and a half. So for those that want to retire before 59 and a half, they get tax-free access to some of their Roth money. Not all of it, but some of it.
Yeah, that's fascinating. And, the way you describe that cake, I eat the icing first anyway, so that makes complete sense to me. When we're talking about the conversion, right, we have to get a CPA. So a couple of questions here. Where do you find a qualified CPA who knows how to do this? Or am I going to my own tax guy or gal? And then the second question is, you're saving money because you're not paying the full tax, right? Because you're converting and you're readjusting the basis. So how much does this typically cost? Are we talking hundreds of dollars, thousands of dollars? Can you talk about those issues a little bit?
The people that you need to bring in to the discount conversion, as we talked about, you need a traditional account or pre-tax account. If you have a 401k with the old employer, what do you need to do? You need to roll that over into a self-directed traditional IRA, or if you qualify, roll it over into a self-directed solo 401k plan because of the UBIT exemption as it arises from debt finance real estate that we've talked about in other podcasts. So that's going to be number one. You got to have a traditional type account. And then number two is a real estate syndication. And I think you started to touch on it a few moments ago, Jim, is if you know you're going to be investing in syndications anyways, and you feel good about it, then why not utilize a strategy like this? And again, it's all going to be based on the individual. I can't make a recommendation and say that you should or shouldn't. But if you know that that's the path forward, then this could be a viable solution. What I do want to be careful about, Jim, is we never want the tax tail to wag the economic dog. In other words, don't go and invest in a syndication just to deploy this tax strategy. Make sure that the investment makes sense for you. And I can't do that due diligence for you. Only you can do that due diligence or work with other people that can help you do that. Number two is an opportunity, a real estate syndication. This is not going to work with stocks, mutual funds. This is not going to work with cryptocurrency. This is not going to work with if you have a single family rental property or you did a private money loan secured by real estate in your traditional account. It doesn't work because you have control and you have liquidity in those types of investments. It works within a syndication type structure because of your lack of liquidity, lack of marketability, we also refer to that as, and your lack of control. Moving on to number three is you need a CPA that can perform this valuation. Not all CPAs can. I would say you can start with your CPA that you work with now and determine if they can help you with this. Some can because it doesn't just have to do with IRAs. It has to do with estates and divorces and other aspects that go outside of the IRA world. Okay, so this discount conversion, this valuation of an alternative asset goes much broader than just IRAs and solo 401k plans, but it's also used in that realm. So I would encourage one to visit with their own CPA, maybe get a referral to a CPA that can help them. There are also CPAs that specialize in the valuation of these types of assets. They oftentimes will have some credentials that's called CVA. I think it stands for Certified Valuation Analyst. And so it's a special, if you will, accreditation or special credentials that a CPA can pursue, advanced education and training that also comes with an exam that they have to pass so that they can add those three letters after their name, CVA, and specialize in this particular area. Once you have those three components, it's then just a matter of executing with your self-directed custodian, or if you have a solo 401k plan, usually that's all self-administered, so you'll just utilize your record-keeping system to accomplish this. To answer your question on fees, Jim, I have seen fees range between $1,000 to $2,000. In many cases, it's about $1,500, about $1,500 to pay a CPA to do this valuation report. Using the example I mentioned before with the woman that I was working with, she invested $100,000. The valuation came in at $55,000. She converted $55,000 of an asset, a real estate syndication, in her traditional bucket of her solo 401k plan into the Roth bucket. She saved about $12,000 to $13,000 in taxes. So that was a no-brainer, right? She paid $1,500 to get the valuation performed, a little bit of work on her part, but she saved how much in taxes? $12,000 to $13,000.
Okay, so last question on this topic. We've talked about traditional IRA converting it to Roth, solo 401k converting it to Roth. Are there differences if you're doing an IRA, if you're doing a solo 401k, or if you're doing a checkbook IRA or a checkbook solo 401k where you have control of the checkbook as well rather than going through a custodian? Can you talk about, are there differences, or is it just kind of, hey, you can do this with any one of those situations, you just have to handle things a little bit differently?
Yeah, so to answer the question, you can do what we're talking about. You can convert from traditional to Roth, whether it's cash, assets, if you do the discount conversion that we talked about, you can do all of that under a self-directed traditional IRA, a self-directed SEP IRA, in many cases a self-directed simple IRA as long as it's seasoned for 2 years. Checkbook IRA is nothing more than your IRA owning an LLC. That LLC owns a property. So could you do it with a checkbook IRA? I don't see why not. As long as it's pre-tax money, you're converting it over to the Roth side. Solo 401k plan. Of course, solo 401k plan, as long as it's self-directed, you can hold alternative assets. With the traditional side of the solo 401k plan, the pre-tax side, you can invest in a real estate syndication and then do your discount conversion to the Roth side of the solo 401k plan. And remember, solo 401k plans, you can roll over many different retirement accounts into the solo 401k plan. Previous employer 401k funds, SEP IRAs, traditional IRAs, TSP. If you have Roth 401k money from a previous employer, that can get rolled over into the solo 401k plan. The only account that you can't roll over into the solo 401k plan is a Roth IRA and then voluntary post-tax contributions to a 401k, which a lot of people don't have anyways, and that would be like an hour-long podcast if we talked about that. The point is you can fund a solo 401k plan through multiple different ways, and then of course you have your annual contributions. Or even better yet, Jim, this is something that I know you didn't ask, but I'll mention for viewers or audience listeners to think about. When you contribute to a solo 401k plan in 2025, as long as you have enough earned income, you can contribute up to $70,000 when you're under the age of 50, up to $77,500 when you're 50 and over. Well, what if in 2025 you made the contribution and you took a full deduction, meaning you didn't put any money into the Roth side? You did all pre-tax and got a $70,000 deduction. And maybe you did that because your income was really, really high in 2025, and you knew that your income was going to be much lower in 2026. Well, couldn't you take advantage of the larger deduction in 2025, use the traditional side, invest in a real estate syndication if that's what you're doing anyways, do the discount conversion, convert the asset over to the Roth side in the year in which your tax rate is much lower, effectively saving taxes, right, over that 2-year period. So that's something for investors to consider. That's going to require obviously much more advanced planning, something that would go beyond the scope of what I can provide, but certainly something you could work with a tax advisor on or do some math on your own if you're sophisticated enough to do that and determine what's going to make the most sense for you.
That's great stuff. Fascinating, all of it. It's complicated, but man, we always talk about taxes are really the biggest eroder of your wealth. And all of these strategies are ways to mitigate, defer, reduce your tax burden. So this has been fascinating. Really appreciate you being on, John. Thank you very much for being on the show again, and look forward to having you again soon.
Yeah, Jim, I appreciate it. And I couldn't agree more with what you just said there. Is taxes can seem complex, but like I always like to say, where complexity lies, opportunity thrives. And it's not just about the rules that are associated with taxes, it's about the exceptions to the rules. That's where a lot of the investors that I've worked with and tax attorneys and CPAs, they live in the exceptions. I talked about a few of those exceptions, like the Roth IRA layered cake. Those are all exceptions to the general rule that you're paying a penalty when you take the money out early. But I just talked about how you could actually take money out of the account early, and that's because of the exceptions. The exception to UBIT, Section 514C9A, one of my most favorite parts of the United States tax code, because it allows investors to use solo 401ks to invest in real estate syndications and effectively be exempt from UBIT, meaning their yield can be much higher. So it's not just about the tax rules, it's also about the exceptions to those tax rules. And I encourage folks to work with their professionals to think about that and develop strategy and do some deeper planning.
Yeah, and we have the right guy on the podcast when he has actual favorite parts of the tax code. That means you're talking to someone who knows what they're talking about. So, John, if people want to hear more from you, get to know you, or connect with you and learn more about equity trust and options there, what's the best way to do that?
Yeah, so a lot of different ways. Website is trustetc.com. We have a YouTube channel with a lot of education. And then, of course, PassivePockets. We're very active, and I'm very active on PassivePockets. You can find me there. You can find our firm, Equity Trust, there. We're happy to answer questions, facilitate a phone call, and see how we might be able to help you from a self-directed IRA, solo 401k, even HSA perspective. But thank you, Jim, for having me on. Always happy to be here.
Big thanks to John Bowens from Equity Trust for breaking down the strategic side of Roth conversions. If you're serious about growing your retirement account and keeping more of it long term, be sure to check out equitytrust.com and PassivePockets.com for more in-depth analysis and up-to-date info. If you found today's episode helpful, be sure to like, subscribe, and leave us a comment at PassivePockets.com. Thanks for tuning in, and as always, happy investing.